Are we back in a real bull market? Or this rally is about to take a 180? This week, traders were celebrating like the bottom was in, as the SP 500 nearly touched 6,000 and the momentum names ripped higher. But right as euphoria peaked, the cracks started to show up again. UnitedHealth lost $300 billion in a week. 30-year yields hit 5%. Moody's downgraded US credit, and Michael Burry, he dumped his entire portfolio and went short against NVDA. If that doesn't scream pullback is incoming, you're not paying attention. Let's break it all down. Here is what we're covering today. The bull market breakout, what's real and what's noise, a full market recap including Trump's tariff reset, UnitedHealth collapse, credit downgrade, options flow, and much more. My trade breakdowns for the week and the new positions I opened, my full technical analysis, key levels I'm watching, setups I'm managing, and where I see traps and opportunities forming, the key catalysts to watch for next week including economic data, Fed speakers, and earnings reports. Let's start with the bull market breakout. The S&P 500 futures briefly flirted with the 6,000 level on Friday. This is a level that traders have been watching for weeks. We closed above 5,973, up 20% from April lows, putting us officially back in a bull market. But this wasn't driven by earnings, Powell, or even data. It was Trump. Sunday night, May 11th, the US and China agreed to a 90-day tariff reset. China slashed tariffs from 125% to 10%. The US cut from 145% to 30%. That news alone had futures ripping higher. Then, on Monday, Trump announced an executive order to cut US drug prices by up to 80%, benchmarking against global rates. This was a direct hit to Big Pharma. If this policy holds, it could upend the entire US drug pricing system. And as an actuary, this is particularly fascinating to me. Pricing dynamics, payer behavior, and risk adjustment models are all interconnected here. And this kind of disruption doesn't happen often. For pharmaceutical companies, it's a margin killer. The US has long been their most profitable market, often charging 5 to 10x more than other countries for the same drugs. That pricing advantage may disappear overnight. For insurers, it's a mixed bag. They'll benefit from lower claims short term, but if the PBP model breaks down, the entire rebate infrastructure could collapse. Pharmacies might see more traffic, but thinner margins. If reimbursements drop with prices, volume won't be enough to offset the squeeze. For consumers, it's a major win. Lower out-of-pocket costs, better access to meds, and fewer financial barriers to stay healthy. It's one of the most disruptive healthcare policies we've seen in years. Do you think that was it for the healthcare sector? Then think again, because what came next wasn't just a correction. It was a full-blown collapse. We're talking about one of the biggest meltdowns the healthcare sector has seen in recent memory. UnitedHealth collapsed over 60% since earnings, and nearly half of that was triggered this week after the Wall Street Journal reported a criminal fraud probe into the company. The company, of course, denied it, but the stock lost over $300 billion in market cap and dragged down the entire healthcare sector. But here's where it gets even more interesting. While the headlines were screaming fraud and collapse, the smart money started stepping in. $25 million worth of shares were bought by the UnitedHealth CEO. A strong signal that they are not backing down and they're betting big on a rebound. $1.5 million in insider buying also showed up in the filings. And options flow? Off the charts. Someone loaded over $16 million in call leaps, betting the sell-off would fade over time. More long-dated bullish bets continued hitting the tape, even as retail traders panicked and headlines screamed collapse. And on top of all that, this marked the third largest daily volume in UnitedHealth's entire history. Historically, those previous volume spikes in 1996 and 1998 marked the bottom, with 45% rallies that followed. So while the chart broke and headlines scared everyone out, insiders are already betting the fear won't last. At the same time, bond markets sent their own message. The 10-year yield hit 4.5% and the 30-year approached 5%. Then, on Friday, just minutes before the close, Moody's downgraded the US credit rating from AAA to AA1, citing rising debt, persisting deficit, and political dysfunction. This downgrade sent a clear message. The US is losing its grip on fiscal stability. It signaled that Moody's now sees the US credit trajectory as deteriorating and made it clear that further downgrades are on the table. That kind of warning can ripple through markets. It could raise borrowing costs for government, drive volatility in the bond market, and even impact the investment rates faced by the consumers, businesses, and local governments. It adds more pressure to federal spending and rattles investor confidence in both the stock market and the US dollar. And while treasuries still function as a global safe haven, the downgrade highlights real structural risks in the US fiscal policy. And politically, it could add more fuel to the fire between Trump and Powell. Trump has been demanding rate cuts, arguing the economy is ready to take off. But a downgrade like this puts even more pressure on the Fed to hold firm, or risk being seen as enabling fiscal recklessness. So how did markets take it? Not well, actually. Futures reacted fast, flashing lower after hours and erasing almost the entire day's rally in under 30 minutes. And just when things felt overheated, one of the market's most notorious bears made his move. Michael Burry, yes, that Michael Burry, liquidated his entire portfolio this quarter. All of it gone, except for one thing. A new stake in Estée Lauder, and top it off, he went short on NVDA. In a market where retail is chasing momentum and tech is flying, that kind of positioning says a lot. And Burry wasn't the only surprise this week. Coinbase was added to S&P 500 and rallied 5%. But later in the week, it was announced that it had been hit with a $20 million ransom hack tied to insider bribery. Bloomberg reported that breach may have started back in January. The stock reacted negatively at first, but still managed to close the week at the highs. But while the red flags were piling up, from hacks to downgrades, sentiment kept climbing. Retail stayed euphoric. The fear and greed index hit 71. We're still in the greed, but we're getting borderline close to extreme greed. Put and call ratio dropped to 0.55. This is the lowest since 2010. And VIX collapsed from over 40 to under 20. And this is where it gets dangerous. We've seen this play out before, the psychology of a market cycle. This is a textbook late cycle behavior. Euphoria at the highs, complacency around risk, and cracks just starting to show. On the macro side, consumer sentiment fell to 50.8, the second lowest on record. 44% of Americans now expect unemployment to rise, and household debt hit $18.2 trillion. Student loan balances reached over $1.6 trillion. Let's go rapid fire. Treasury April surplus was $258 billion, but the fiscal deficit still topped over $1 trillion. Warren Buffett rotated, trimmed Bank of America, dumped Citi, and added Constellation Brands, Hagel Corporation, and Domino's. PPI missed badly, came in at negative 0.5% versus positive 0.2% expected. 33 million in Max 7 puts hit Friday before the close. SMCI options spiked right before their Saudi partnership news broke. Jamie Dimon continued warning of recession risk even as the market rallied. So yeah, the market's been ripping, but let's be real, the cracks underneath are getting harder to ignore. Let's shift gears and break down the trades that I actually took. The wins, the losses, and what I'm still holding. Every one of those were shared in a newsletter ahead of the time. So if you're on it, you saw these moves coming. Starting with the SPY Lottos. This was a weekend swing trade. I opened SPY 570 and 575 call spreads at $1.40 heading into tariff reset headline. Closed it out on Monday for $4.10. That's a 193% gain. Clean break on the macro momentum. Midweek, I took a shot on short-term reversal. Bought 10 SPY May 15 585 puts at $1.35. Closed next day at $1.11 when it didn't follow through for a small loss. I also closed out my swing on Robinhood shares. Sold it at $56.17 after entering at $41.63. That's around $5,000 profit. Played the inverse head and shoulders and the wedge breakout perfectly as I discussed in the newsletter. I also took a small starting position in Webull, which I called out in the newsletter earlier this week and also in last week's recap video. I went with June 20th 15 strike calls at $1.30 per contract, but I think I may have rushed this one since the stock went down after I entered. I still have over a month, so I won't add more unless I see the pattern confirming the upside momentum. For HIMS, I had two setups. First, the 516.37 puts, early entry into the breakdown play. then added 50-45 put spreads expiring the same day. Both legs didn't confirm and I let the positions expire worthless. Loss taken, moving on. All these setups, entries, exits, contexts were shared in real time in the newsletter and the weekly recap videos. If you want them early, before the video drops, make sure you're subscribed. It's completely free. I've also got a few new setups I'm watching closely and some new trades I opened this week that I will only be sharing in the newsletter. But I also entered a few positions on names we've covered before, and I'll walk through those in the technical chart breakdown coming next. Let's dive in. Starting with the hourly chart of SPY, we've been stuck in a rising wedge pattern that's been forming since April 9th. We've been trading within this range ever since. On Monday, we gapped up following the China tariff news. But despite that momentum, prices only managed to climb 5% higher over the entire week. The MACD on the hourly flipped to bearish territory, and we saw an after-hours drop following Moody's credit downgrade announcement. Zooming out to the daily chart, the rising wedge becomes even more apparent. We saw a gap up over 2% on Monday, and the market continued climbing higher throughout the week. At this point, many are expecting a 4 to 5% pullback to retest the 200-day moving average. That would be a healthy correction, and if we bounce from that level, it could set us up for another move to new highs. The RSI is now approaching to overbought conditions, and MACD is losing momentum. There is also an open gap around 566, and ideally, if we can fill that gap during a pullback, but still close above the 200-day moving average, that would be the ideal scenario for bulls. Given all this, I entered 590 and 585 put spreads expiring next Friday. With the added weight of Moody's downgrade, I think this setup has a strong potential to be another profitable trade. The daily chart of S&P 500 futures, ES, tells a similar story. We've been in an uptrend since April 9th announcement, but momentum now appears to be slowing. The RSI is approaching overbought territory, suggesting a pullback is highly likely, most likely to reset the 200-day moving average. Just like the SPY, there is also a gap below the 200-day moving average around 5,688. The key question is whether we can fill that gap and still close above the 200-day moving average. As long as we can hold that level by end of next week, I would say the risk is still to the upside. However, if we lose the 200-day moving average and more importantly, close below the 50-week moving average, then this recent move was most likely another bear market rally, or in other words, a bull trap. Also worth noting, even after this week's rally, the MACD still hasn't given us bullish confirmation. I know it's a lagging indicator, but from a more conservative standpoint, I would prefer to see that confirmation before fully tilting bullish. The hourly chart of triple Qs is also trading in a rising wedge similar to SPY. One key difference though is that Friday's post-market sell-off was more violent in triple Qs than in SPY. This was largely driven by sharp sell-off in risk-on assets like tech and semiconductors. Right now, the expectation is for that selling pressure to continue into Monday. That said, once we approach the 510 support level, I believe the RSI will likely be in oversold territory at that point, and I would expect a short-term bounce or consolidation on the hourly chart. Switching over to the daily time frame, things look overextended. RSI is in overbought territory. There is a massive gap near the 491, which also happens to be close to the 200-day moving average. A reversal and a retest of the 200-day moving average is something we should be prepared for. If that retest holds, we'll likely see new highs from there. But as most of you know, I lean a bit more bearish given the macro headwinds and the outstanding issues we've discussed earlier. Overall, expect both the triple Qs and the Nasdaq futures to follow whatever the S&P 500 does. Speaking of the futures, let's take a look at that. Looking at the daily chart of the Nasdaq futures, we printed back-to-back doji candles on Thursday and Friday, signaling indecision, and more importantly, we closed below my resistance level at 21,414. Technically, there are a few red flags starting to line up. First, we are trading within a rising wedge pattern, which carries a high probability of breaking to the downside. Second, the RSI is bordering on overbought territory. And third, we're seeing a clear loss of momentum in MACD. On top of that, there's also an open gap just below the 200-day moving average that will likely need to be filled at some point. Add in all the bearish headlines we saw on Friday, and I think a pullback in the futures is very likely. That said, I'm not panicking. I've got hedges in place on SPY and some other names, and they should be more than enough to keep me covered. VIX is still dumping, and I try to time this move for next week, but honestly it looks like the play is going to be a dud unless we somehow shoot past 25. I know I mentioned I would cut the trade if we drop below 21, one, but I got sidetracked and kind of forgot about it. Luckily, I didn't size in too heavy, so it's not a big deal. From a technical standpoint, the MACD is slowly trying to flip bullish, and we are still trading inside the narrow folding wedge pattern, which could eventually break higher. For now though, volatility remains crashed. That said, this environment has made hedging and buying put insanely cheap compared to last few months. So if I were you, I would consider grabbing some protection before the market decides to correct. That's exactly what I did last week, and I'll be looking to add more if we break below the 200-day moving average on the futures. IWM is still lagging. Small caps just aren't getting any love right now. This really backs up the point I've been making in the last few recaps. Most of this rally has been driven by tech and cheap stocks. It's hard to bet on IWM when we're seeing major weakness in the consumer and consumer sentiment dropping to historical lows. Unlike the S&P 500 and Nasdaq, IWM hasn't reached its 200-day moving average yet. If we end up gapping down on Monday, we will have a classic island reversal setup. And if I see that play out, I'm going to take a shot on a pullback toward the 200 support level, which also lines up with the 50-day moving average. Looking at the NVDA, we hit the 125 level as I mentioned in the last recap video, and pushed even higher before closing just below the key resistance at 136.73. The chart is becoming overextended with the RSI in the overbought territory. We're also sitting above multiple open gaps that will likely get filled at some point, especially if momentum starts to fade. Losing momentum here could lead to a quick pullback, which would be healthy in a short term. Losing the 200-day moving average, however, would be a much more bearish development and a potential signal for further downside. And let's not ignore Michael Burry's short position on NVIDIA. It doesn't necessarily mean a crash is coming, but it adds weight to the idea that some smart money is expecting a reversal. Right now, the risk is tilted to the downside, at least in the near term. If we do pull back and fill the gaps, then hold the key levels, that could set up for the next leg higher. But we're not there yet. Tesla has been ripping higher like a rocket ship, but it's important to note that most of this move has been driven by aggressive options flow. Millions of dollars flowing into call options, which has fueled a gamma squeeze style rally, and we also had massive shorts covering. Personally, I wouldn't be chasing here. If you're in from lower levels, this is the area where I would look to book profits. The RSI is elevated, and I would prefer to see a pullback and a cool down, followed by a consolidation with momentum still holding before considering re-entry to the long side. There's also a gap near the 400 level which hasn't been filled. I'm not saying we head there immediately, but historically gaps tend to get filled eventually. So it's something to keep in mind for longer term. For now, I'll be cautious and let this one reset before jumping in. Apple has been the laggard, the weakest link in Mag 7 throughout this rally. It did gap up after the China news, but spent the rest of the week just stuck in this zone, unable to close above 213 resistance level. We're currently holding the 50-day moving average, but I'm still leaning really bearish on this name. Given the overall weakness in sentiment and a potential for a pullback in the indices, I went ahead and entered 210 and 205 put spreads expiring next Friday. If we gap down on Monday, they would set up for another island reversal, and I'll be watching for a potential gap close near the 200 level. At the same time, we failed just short of the 200-day moving average. We couldn't close the gap above near the 220. The MACD is losing momentum too. So overall, I think the risk is clearly to the downside here. The daily chart of crude oil has been holding that key 61 and 55 level. We haven't been able to break above the 50-day moving average, but as long as we stay above 61 and 55, this could still play out as an ABC pattern. Right now, we're still consolidating in a bull flag pattern, which could break higher if momentum kicks in. But keep in mind, crude is extremely sensitive to macro headlines. Any major global development can easily swing it in either direction. Also, just a heads up, higher oil prices tend to be an early warning sign for rising inflation, so it's something worth watching closely. The daily chart of US dollar played out the head and shoulders pattern we called out in last week's recap video, hitting our target around 102 before reversing. After that, we broke below 101 level, and right now we're consolidating in what looks like a bear flag pattern. If that pattern breaks down, we could be heading lower to retest the 100 level, which would be the next key area of support. Early in the week, we also saw headlines about major whales dumping the US dollar and rotating into other currencies for safety, which only adds to the bearish pressure here. That said, Given the recent positive correlation between the dollar and S&P 500, a continued drop in dollar could actually be a headwind for equities, especially if it reflects broader risk-off sentiment or global capital rotation out of US assets. Looking at the daily chart of TLT, it continued to play out the bear flag pattern we called out 2 weeks ago and again in last week's video. We did catch support around 85 and tried to rebound but got rejected at 87 resistance level. The MACD is starting to lose its bearish momentum and looks like it's about to flip bullish, but we are not there yet. We still need to reclaim the 87 resistance and more importantly break out of this downward trend line to confirm any kind of reversal. So the question is this the beginning of a double bottom and a potential move higher for TLT? Or is this just another pause before the downtrend continues? To help answer that, let's take a look at Treasury yields. Let's take a look at the 10-year Treasury yields. On the daily chart, we saw both the falling wedge and the bullish flag patterns play out, but we ended up closing below the key 4.5% level. Now, if we close below the 4.37%, that opens the door for a possible double top formation. In that case, the neckline would be around 4.11%, and if we lose that, we're likely heading lower to retest April lows. The bearish engulfing candle from Thursday makes this scenario even more likely in my view. If that plays out and we see rates heading lower, then we should see TLT starting pushing higher, which would also confirm the double bottom we've been watching in TLT. But let's not forget the elephant in the room, Moody's credit downgrade. When the headlines hit the tape, yields spiked higher. So we've got some conflicting signals here, and I think we'll get a confirmation for the direction on Monday. Technicals out of the way, let's take a look what could drive markets next week, starting with the economic calendar. On Monday, we have leading indicators and some Fed speakers. On Tuesday, we have a lot more Fed speakers. Wednesday as well. Thursday, we have jobless claims, flash PMI, and existing home sales. On Friday, we have new home sales and more Fed speakers. On Sunday, we have Powell speaking. Yep, it's a Powell speech at a college graduation, because apparently we're not even allowed to relax on the weekend without wondering if Powell's going to accidentally tank the market in a cap and gown. Now, let's talk earnings. On Monday, we have Zim and Trip.com. On Tuesday, we have Home Depot, Palo Alto Network. On Wednesday, we have Baidu, TGX, Target, Wix, Zoom, and Snowflake. On Thursday, we have TD Bank, Deckers, Intuit, Ross, Workday, and Autodesk. On Friday, we don't really have any major earnings. Alright, let's wrap this up. We're standing at the edge of a breakout, but walking a tightrope. Yes, the S&P almost hit 6,000. Yes, the sentiment is euphoric. But beneath the surface, the market's internals tell us a very different story. We saw a healthcare sector collapse, a US credit downgrade, insider trades stacking in both directions, and Michael Burry bailing out on the entire market. Throw in rising yields, weakening consumer data, and a surge of insider activity across key sectors, and one thing is clear. This is no time to get complacent. Here is what I'm watching heading into next week. How markets respond to the credit downgrade. Whether bond yields keep climbing or start to reverse, key earnings from retail, tech, and enterprise, and insider flow in sectors under pressure, especially healthcare and tech. Keep your playbook flexible, watch the levels, and most importantly, don't get distracted by the surface level noise. This week was a perfect reminder. Follow the flow, watch the positioning, and let the price action do the talking. If this helped bring clarity, hit the like, subscribe, and get on the newsletter. It's completely free, and it's where I cover potential trade setups before they hit the recap videos. The next newsletter goes out today in the evening, and I'll be including a few additional trade setups not covered in this video, along with my full positioning. Let me know in the comments what trades or setups you're watching, and what charts you would like me to cover in future recap videos. Thanks for watching, and I will see you in the next one.